You've probably heard it before. Investing is only for the rich, or you need millions to make real money. But what if I told you that with as little as $1,000 or $2,000, you could start building a passive income stream of $5,000 per month? The truth is, most people miss out on this opportunity because they think it's too complex, too risky, or just unattainable. In this video, I'm breaking down those myths and showing you how anyone can build wealth with the power of index funds. I'll show you the problem with traditional index fund investing, how to reach $5,000 with only a $2,000 one-time investment, and in the end, I'll show you how to reach the same goal 10 years faster. So why index funds? Index funds are a straightforward and reliable investment choice. They don't require deep research or stock picking and instead track the market's overall performance, providing consistent long-term growth. This makes them ideal for both beginners and experienced investors looking for a low-maintenance way to grow their wealth. Their strength lies in diversification. By spreading your investment across hundreds of companies, index funds reduce the risk associated with individual stocks while still offering competitive returns. Over time, this approach leads to compounded growth, building a solid financial foundation. Now, you may have a couple of questions. How much do I need per month for a healthy lifestyle? And how much do I need to invest to turn those index fund dividends into a steady income stream? If your goal is covering your monthly expenses, with $1,000 or $2,000 left after that with dividends, there's a bit of math involved, but don't worry, I'm breaking it all down for you. Let's say $5,000 a month. That's $60,000 a year. When it comes to financial independence, $5,000 per month often comes as the magic number. Why? Because it provides a comfortable standard of living for most people, covering essentials like housing, groceries, transportation, and even some luxuries. This target gives you a clear benchmark to work towards, but it also raises an important question. How much do you need to invest to get there? The answer lies in dividend yields, which determine how much income your investments produce relative to their value. For example, investments with higher dividend yields will require less capital to reach the $5,000 monthly goal, while lower yields demand significantly more. However, chasing only high yields can be risky, as these investments often sacrifice long-term growth or stability. The challenge is to strike the right balance between reliable income and sustainable growth. This is where investing in indexes comes into play. But as we'll see, relying solely on indexes like the S&P 500 for income might not be the best strategy. The S&P 500 is like the king of index funds, and it's a great benchmark for how the market performs. But if you're planning to live off its dividends, you might be in for a surprise. Let's crunch the numbers. Achieving $5,000 per month in dividends is a major milestone for financial independence. However, not all investment strategies are created equal when it comes to hitting that target. Let's take the S&P 500 as an example. It's the gold standard for long-term growth, but how does it fare when your goal is reliable income? Let's take a portfolio of ETFs that track the S&P 500, like SPY, VOO, and IVV. These funds are great for growing your money over time, but their average dividend yield, the portion of income they pay you, is only 1.24%. Now, let's say you want $5,000 a month in income, which adds up to $60,000 a year. To figure out how much you'd need to invest, you divide your income goal, $60,000, by the dividend yield, 1.24%. Here's the math. $60,000 divided by 1.24% equals $5 million. So to make $60,000 a year from these ETFs, you'd need to invest a massive $5 million up front. Why so much? It's because the dividend yield, 1.24%, is quite low. While these funds are excellent for long-term growth, they're not designed to provide big payouts in the short term. But what if you have time on your side? Investing isn't just about the dividend yield, especially when we're talking about the S&P 500, which has been a cornerstone of the market for decades, long before we were ever born. Its real power lies in its growth potential over time. Let me explain. Take John, for instance. Suppose John invests a hefty $700,000 into a portfolio of ETFs tracking the S&P 500. With an average dividend yield of just 1.24%, John would earn $8,680 in dividends during the first year. That's about $723 per month. Not exactly life-changing for an investment of this size, right? But this is where the dividend growth factor, or compounding, kicks in with a rate of 6.78% annually. Fast forward 10 years and John's dividends would grow to $1,360 per month. By the 20-year mark, his monthly dividends would reach $2,654. Finally, after 30 years, John would hit $60,808 in annual dividends, or about $5,067 per month. While these numbers are impressive, let's be real. Reaching this level takes 3 decades of patience and locking away $700,000, a sum out of reach for most people. The real growth in the S&P 500 comes from share price appreciation. Assuming an average individual return of 11.27%, your $700,000 could grow to over $20 million in 30 years. While this figure is impressive, it's not income you can live off without selling assets, which defeats the purpose of relying on dividends alone. This isn't to say that the S&P 500 is a bad investment. It's fantastic for growth-oriented strategies, but if your goal is a steady, spendable income, you need to consider alternatives. In the end, I'll show you a portfolio of index funds that can deliver $5,000 per month with just a $2,000 initial investment, and a way to make it 10 years faster. Before that, let's look at how we can work index funds to achieve $5,000 per month. Okay, so index funds that focus on providing higher dividend yields and diversified income streams without requiring astronomical starting amounts. And when you're starting small, $2,000 becomes the perfect stepping stone. Why this amount? It's simple. It's accessible for beginners, maybe like you, and practical enough to demonstrate how to start generating passive income. You don't need to save for decades to begin investing, and it sets realistic expectations for entry-level investors. With $2,000, you can construct a well-balanced portfolio of funds offering a mix of solid dividends and long-term growth. The idea isn't to live entirely off this amount right away, but to show how even a small investment can grow into something sustainable over time. Take, for example, a diversified portfolio offering a dividend yield of 2.44%, higher than the 1.24% from S&P 500 ETFs. With such a yield, $2,000 would generate about $48.80 annually in dividends, which might seem small, but represents a starting point for compounding and reinvestment. Over time, with consistent dividend reinvestment and market appreciation, that initial $2,000 can grow exponentially. Funds like the Fidelity Total Market Index Fund and Fidelity Real Estate Index Fund are perfect examples of investments that balance yield, growth, and stability. The Fidelity Real Estate Index Fund alone has a dividend yield of 5.88%, providing significant income potential while benefiting from real estate's historically strong performance in inflationary periods. This approach sets the stage for anyone looking for a practical and achievable way to live off their investments. So why settle for low yields when you can aim higher? The key is creating a well-balanced portfolio that delivers steady income without compromising on growth, and we're diving into exactly how to do that next. Here's why building a diversified portfolio is essential to make $2,000 work effectively: compounding and diversification. Let me break these down using a portfolio of 5 carefully selected index funds. This portfolio stands out because it's designed to deliver a blend of reliable dividend income and capital appreciation, making it far superior to ETFs tracking the S&P 500 in terms of meeting income goals. Let's break it down. The Fidelity Midcap Index Fund, with the ticker FSMDX, offers a dividend yield of 2.27%, paired with an impressive dividend growth rate of 18.74%. This means your income isn't static, it grows every year, amplifying the power of compounding. The Fidelity Real Estate Index Fund, with the ticker FSRNX, offers a high dividend yield of 5.88% and provides immediate income potential, something the S&P 500 ETFs can't match. Real estate investments like FSRNX add stability, especially during market downturns, giving you peace of mind while boosting your portfolio's income capacity. The Direction NASDAQ 100 Equal-Weighted Index Shares, with the ticker QQQE, brings strong capital appreciation with an annual growth rate of 11.28%. The Vanguard MegaCap Index Fund ETF, with the ticker MGC, is another essential piece of the puzzle. Its exposure to the largest U.S. companies offers stability and consistency, with a dividend yield of 1.16% and a growth rate of 7.24%. The Fidelity Total Market Index Fund, with the ticker FSKAX, brings broad market exposure and a staggering dividend growth rate of 25.52%. So now you've got a well-rounded portfolio that benefits from both income and long-term market trends. Like the S&P 500 ETFs, this portfolio is tailored for both income and growth. While S&P 500 ETFs primarily focus on capital appreciation with low yields, this mix includes higher-yielding options like FSRNX alongside growth-oriented funds like FSMDX. The result? A portfolio that generates meaningful dividends while still participating in long-term market gains. Compounding is the secret sauce that makes small investments grow into significant wealth. In simple terms, it means earning returns not just on your initial investment, but also on the returns you reinvest. For example, starting with $2,000, your first-year dividend of $48.80 might not seem like much, but reinvest those dividends back into your portfolio, and now you're earning dividends of $2,048 the next year. Each cycle of reinvestment adds fuel to the growth engine, turning a modest starting amount into a much larger investment over time. Diversification makes sure your $2,000 investment isn't tied to the performance of any single sector. This portfolio spans multiple asset classes like real estate, mid-cap growth, and total market exposure, each contributing to income and growth in its own way. For instance, FSMDX offers a dividend yield of 2.27% and a stellar dividend growth rate of 18.74%, providing a dynamic growth engine. Meanwhile, FSRNX delivers an impressive initial yield of 5.88%, perfect for immediate income needs. Together, these funds strike a balance between short-term income and long-term growth. Let's crunch some numbers together to see how this portfolio could grow over time. Here's what we know so far. We know our portfolio has a 2.44% dividend yield. Better yet, that income grows at 16.76% per year. Plus, the portfolio's share prices grow at an average of 8.15% annually, making your investment worth more over time. Based on these metrics, if you invest $2,000 in this portfolio, here's how it plays out. In the first year, your portfolio would increase to $2,212, a modest start. But by year 10, it would grow to $6,094, and that's when the magic of compounding really starts to kick in. By year 20, your portfolio would be worth $27,930, and by year 30, it would reach $306,169. At this point, your investment would pay $60,744 annually in dividends, or about $5,062 per month in dividend income. Now let's say you want to reach the same goal, but slightly faster. But remember, like we said in the beginning, if you have a low investment, you need a longer time to reach the goal. And to reach the goal faster, you need to increase the investment. So let's say this time you start with a $10,000 initial investment and also make a weekly contribution of, let's say, $100. Here's how much time you would save with this approach. By the end of the first year, your portfolio will be valued at $16,259. By year 10, it would grow to $122,828, and that's when the magic of compounding really starts to kick in. By year 20, your portfolio would be worth $681,998, paying $66,171 in annual dividends, or about $5,514 in monthly dividend income. Want to go super safe? Here's what happens if you invest $10,000 in different treasury bonds.